Picture this. You wake up one morning, check your portfolio, and despite a brutal market downturn that wiped out retirement accounts across the country, your wealth is essentially untouched. Not just untouched, but quietly, steadily growing. That is not a fantasy. That is what happens when you build your financial life around principles that have been tested across centuries of wars, economic collapses, currency failures, and political upheaval. And those principles did not come from Wall Street. They came from Switzerland. Switzerland has been managing and preserving wealth for over 200 years. The country survived 2 world wars without being invaded, maintained a stable currency while empires around it collapsed, and built a financial system that wealthy families from every corner of the globe trust with their most sensitive assets. The Swiss did not get lucky. They built a philosophy, a set of money rules so disciplined, so counterintuitive to how most people think about wealth, that once you understand them, you cannot unsee them. Today, we are going through 7 of those rules. These are not generic personal finance tips. No advice to cut your lattes or automate your savings. These are the deeper structural principles that explain why Swiss private banks have clients who have been with them for 4 and 5 generations. Why Swiss family offices compound wealth across decades without dramatic crashes, and why the Swiss approach to money feels almost boring from the outside, but produces extraordinary results from the inside. Stay with me through all 7, because the final rule is the one most people never hear about, and it might be the most powerful of all. Let us start. Rule number 1. Capital preservation comes before capital growth. This sounds simple until you actually internalize what it means. Most investors in the modern era have been conditioned to chase returns. The conversation is always about what went up, what is performing, what the hot sector is. Swiss wealth philosophy flips this entirely. The first question is never how much can I make? It is how much can I afford to lose? The answer, in the Swiss tradition, is as little as possible. Warren Buffett famously said his first rule of investing is never lose money. His second rule is never forget, rule number 1. But Buffett got that principle from somewhere. The deeper roots of that thinking live in the Swiss banking culture that developed through centuries of watching what happens to wealth when it is not protected first. Swiss private banks historically spent more time on downside scenarios than upside projections. They stress-tested portfolios against historical catastrophes before they ever discussed potential gains. Why does this matter practically? Because of the mathematics of loss recovery. If your portfolio drops 50%, you need a 100% gain just to break even. A 30% loss requires a 43% gain to recover. Losses hurt you asymmetrically. The Swiss understood this math at an institutional level long before behavioral finance gave it a name. When you build your strategy around preserving what you have first, growth becomes a secondary benefit rather than the primary objective, and paradoxically, you often end up with more of it over time. Rule number 2. Diversification is not a strategy. It is a survival mechanism. And the Swiss definition of diversification goes far beyond what most people practice. Most investors think they are diversified because they own stocks across different industries, or maybe they have some bonds mixed in. Swiss diversification operates across entirely different categories: asset classes, geographies, currencies, time horizons, and even political jurisdictions. Governance structures. The Swiss built redundancy into their national DNA. That same logic applies to how they think about storing wealth. Swiss investors traditionally hold assets in multiple countries, not because they distrust one country specifically, but because they distrust the concept of concentration itself. If your wealth is entirely denominated in one currency, governed by one legal system, held in one country, you have a single point of failure. And single points of failure, given enough time, eventually fail. Practical application here means genuinely examining where your wealth actually lives. Not just what it is invested in, but where the legal ownership resides, what currency it is denominated in, and which government ultimately has jurisdiction over it. True Swiss-style diversification means that no single political decision, no single currency crisis, no single market collapse can wipe out everything at once. Parts of your wealth may take a hit. The whole never should. Rule number 3. The Swiss relationship with gold is not sentimental. It is structural. Switzerland holds one of the largest gold reserves per capita of any nation on Earth. Swiss banks have been central to the global gold market for generations. But this is not about believing gold will skyrocket or that everything else will collapse. The Swiss use gold specifically because it is the one asset that carries no counterparty risk. Every other financial asset you own represents someone else's promise. Stocks represent a claim on a company's future earnings. Bonds represent a promise to repay. Bank deposits represent the bank's obligation to you. Even real estate depends on the stability of property law, taxation systems, and local governance. Gold is the one globally recognized store of value that does not depend on any institution's promise to honor it. When you hold physical gold, you hold something that has been recognized as wealth across every culture and every century. Swiss wealth managers traditionally recommend allocating a meaningful portion of a portfolio to gold not as speculation, but as insurance. This percentage varies, but the principle is consistent. It is the anchor that holds value when paper promises start to unravel. The key distinction the Swiss make is between allocated physical gold you actually own, stored securely, versus paper gold products that still carry counterparty risk. The physical reality matters. The certificate version defeats the entire purpose. Rule number 4. Privacy and discretion are financial assets, not just preferences. Swiss banking secrecy became legendary for a reason, and while its legal structure has evolved over the decades, the underlying philosophy remains a cornerstone of Swiss wealth thinking. Information about your wealth is itself a source of risk. The Swiss understood this when most people had not even considered it. When details about your assets become widely known, you become a target for litigation, for excessive taxation, for fraud, for social pressure to behave in ways that are not in your financial interest. The wealthy families who preserved their fortunes across generations in Swiss private banks did so partly because those banks operated with a level of discretion that created a shield around their clients' financial lives. That discretion allowed long-term decision-making without short-term interference. In the modern context, applying this rule means being thoughtful about who knows the details of your financial situation. It means structuring your assets with appropriate legal tools like trusts, holding companies, and foundations where relevant and legal to create layers of privacy and protection. It means understanding that transparency, while virtuous in civic life, is often a liability in personal wealth management. The Swiss did not invent financial privacy because they were hiding something sinister. They invented it because experience taught them that exposed wealth invites destruction. Rule number 5. Long-termism is the competitive advantage that most people refuse to use. Swiss banks have clients whose families have been with them for over 100 years. Think about what that means. Those relationships span world wars, the Great Depression, multiple currency collapses, technological revolutions, and complete transformations of the global economic order. That continuity is only possible when both the institution and the client share a radically long-term perspective. Most individual investors operate with a time horizon measured in quarters, sometimes months, sometimes weeks. Swiss wealth philosophy operates in decades and generations. This is not just philosophical. It has profound practical implications for what you invest in, how much volatility you can tolerate, and what kinds of risks make sense to take. If your time horizon is 20 years, a 30% market downturn is an inconvenience and an opportunity. If your time horizon is 20 months, it is a catastrophe. The Swiss also apply long-termism to their choice of financial partners. Swiss private banks are extraordinarily selective about clients. but clients are also expected to be selective and committed in return. Short-term thinking is treated almost as a character flaw in Swiss financial culture. The ability to stay the course, to not panic sell, to not chase the latest trend, to not get distracted by short-term noise, is treated as a core competency that separates families who build lasting wealth from those who create it once and lose it in a generation. Compound interest, which Einstein may or may not have called the eighth wonder of the world, only works if you give it enough time. Interrupting the compounding process with panic decisions or strategy switches is one of the most expensive mistakes any investor can make. The Swiss simply refuse to make it. And over generations, that refusal translates into wealth accumulation that looks almost incomprehensible to people operating with shorter time horizons. Rule number 6. Liquidity is not the enemy of returns. It is the source of opportunity. This is a nuanced one that gets misunderstood. Many investors, especially those reaching for higher yields, get fully invested with no cash reserve, no liquid assets, and no dry powder. They see holding cash as a drag on performance. The Swiss see it entirely differently. Holding liquidity is how you position yourself to capitalize on everyone else's panic. Historically, the greatest wealth-building moments in financial markets have occurred during crises, when asset prices collapse, when fear takes over, when distressed sellers overwhelm the market. The buyers who have liquidity ready can acquire assets at extraordinary discounts. Swiss wealth managers built liquidity reserves precisely for these moments, not because they predicted exactly when a crisis would hit, but because they knew, with certainty, that a crisis would eventually hit. And when it did, they wanted to be buyers, not sellers. This is also connected to rule number 1 about capital preservation. When you are not leveraged, when you are not desperate, when your essential living expenses are covered by stable income and your liquid reserves, you have something most investors lack during downturns. Choice. You can choose to wait. You can choose to buy. You can choose to do nothing. That freedom of choice is enormously valuable, and it only exists if you maintained liquidity when everyone else was telling you it was wasteful. The practical guideline here is to always maintain a strategic liquidity reserve separate from your emergency fund. Think of it as your opportunity fund. It sits there appearing idle until the moment when it becomes your most productive asset, the thing that lets you buy quality assets at half price while others are selling them in a panic to cover their losses. Rule number 7. This is the one almost nobody talks about. The Swiss concept of Masigong, the German word that roughly translates to moderation or restraint, but carries a deeper cultural meaning in the Swiss context. It is the deliberate choice to not extract maximum possible returns, not to stretch for every last percentage point of yield, not to optimize every financial decision to its theoretical limit. And it is the reason Swiss wealth survives across generations while others do not. Here is what happens when you pursue maximum optimization in your financial life. You take on leverage because it amplifies returns. You concentrate into your highest conviction positions because diversification dilutes your best ideas. You sacrifice liquidity for yield because idle cash is a waste. You minimize taxes so aggressively that you expose yourself to legal and regulatory risk. Each individual decision sounds rational. Collectively, they create a portfolio that is stretched to its limits, with no room for error, and the real world never fails to provide errors. The Swiss approach accepts a slightly lower return in exchange for dramatically lower fragility. A portfolio that reliably returns 8% per year with low volatility will outperform a portfolio that averages 12%, but experiences violent swings and occasional catastrophic losses, not just emotionally but mathematically because of the asymmetry of losses we discussed in rule number 1. Masigong is essentially the financial application of engineering safety margins. You never build a bridge that can just barely hold its maximum load. You build it to hold several times that load because reality is messier than theory. In practical terms, this means deliberately leaving returns on the table. It means not using the maximum available leverage even when the math says you could. It means not concentrating into your single best idea, even when you are convinced about it. It means accepting that your portfolio will not be the best performing in any given bull market and being absolutely fine with that, because it will also not be the worst performing when things go wrong. And things always go wrong eventually. Now let us talk about how these 7 rules work together as a system, because individually they are powerful, but the real magic is how they reinforce each other. Capital preservation first creates the foundation. Without it, everything else is built on sand. True diversification protects that foundation across multiple dimensions simultaneously. Gold provides the anchor that holds when financial promises start failing. Privacy protects your decision-making freedom from external pressure. Long-termism unlocks compounding and reduces the cost of volatility. Liquidity gives you the power to act when others cannot. And Masigong, restraint, keeps the whole system operating below its stress limits, giving it the resilience to survive whatever the world throws at it. This is a philosophy designed not for one market cycle, but for multiple lifetimes. And that is the point. Swiss banking culture was shaped by clients who genuinely needed their wealth to survive across generations. Not just their children's generation, but their grandchildren's and great-grandchildren's. When you are managing wealth on that time scale, every decision looks different. You stop trying to win the year and start trying to survive the century. Let us get concrete about how you can start applying this framework regardless of your current wealth level. These are not principles reserved for the ultra-wealthy. They scale. Starting with Rule 1, ask yourself what your actual downside protection looks like. What percentage of your portfolio could disappear without destroying your life? Whatever that threshold is, build protection mechanisms around it. Stop losses, position sizing, allocation limits. Make capital preservation an explicit, written, documented priority in your investment approach, not just a feeling. For Rule 2, map your current diversification honestly. Look at it geographically, by currency, by asset class, and by legal jurisdiction. Most people who think they are diversified are actually concentrated in ways they have not examined. Even spreading across global index funds still means you hold everything in one currency if you are measuring your wealth in dollars or euros. Consider whether some meaningful portion of your savings should exist outside your home currency and jurisdiction. For Rule 3, examine your current exposure to assets with no counterparty risk. Gold is the primary example. If you hold any, is it physical allocated gold or a paper product? If it is a paper product like an ETF or a certificate, understand that you still have counterparty risk, and that is not the Swiss model. Physical gold stored securely, ideally in multiple locations, is what the Swiss philosophy actually calls for. For Rule 4, do a privacy audit of your financial life. Who knows what about your assets? This is not about illegal secrecy. It is about appropriate discretion. Consider whether your asset structures, the legal vehicles that hold your wealth, provide adequate privacy and legal protection. Consult with legal and financial professionals about whether structures like family trusts or holding companies make sense for your situation. For Rule 5, write down your actual investment time horizon. Not what you tell yourself it is, but what your emotional reaction to a 30% portfolio drop would reveal it to be. If that drop would cause you to sell, your real-time horizon is shorter than you think. Then make structural decisions that match your actual psychology. Build a portfolio you can genuinely hold through a severe downturn without flinching. That might mean accepting lower potential returns in exchange for lower volatility. For Rule 6, create a dedicated opportunity fund. This is separate from your emergency fund and separate from your investment portfolio. It is liquid, safe, boring, and ready. Size it based on the types of opportunities you want to be able to take. If you want to be able to buy meaningful amounts of real estate or stocks during a crash, size it accordingly. Then leave it alone and wait. The market will eventually provide the moment to deploy it. For Rule 7, deliberately choose not to maximize. Pick one area of your financial life where you are currently pushing toward maximum optimization and intentionally pull back. Maybe you are using some leverage. Maybe you are over-concentrated in a few positions. Maybe you are holding essentially no cash. Introduce some margin of safety. Accept a slightly lower theoretical return in exchange for meaningfully higher resilience. Do it consciously and observe how it changes not just your portfolio's risk profile, but your relationship with your money. The Swiss did not build the world's most respected wealth preservation system by being smarter than everyone else. They built it by being more patient, more disciplined, and more focused on not losing than on winning. They built it by treating wealth as something to be stewarded rather than exploited. And they built it across generations of clients who had seen enough history to know that the world can, and periodically does, turn upside down. And when it does, the families that survive and thrive are not the ones who had the highest returns in the years before. They are the ones who built systems specifically designed to survive the chaos. That is the deeper lesson here. In a world that rewards aggression, concentration, leverage, and short-term performance, the Swiss chose a different path. And that different path, counterintuitively, produced extraordinary long-term outcomes. Boring, steady, disciplined, resilient wealth preservation that compounds across human lifetimes. If you made it to the end of this video, you are already thinking differently from most people about money. The fact that you sat through 7 principles without a single hot stock tip or get-rich shortcut tells me something about how you approach this. So take one rule from today, just one, and apply it this week. Write it down. Tell someone about it. Make it real. And if you want to go deeper on any of these principles, especially Rule 7, the Masigong concept, because it is genuinely one of the most underappreciated ideas in all of personal finance, drop that in the comments and I will make a dedicated video breaking it down fully. Hit subscribe if you want more content like this, because we are just getting started. See you in the next one.